There is a distinct moment in, well, almost every strategy game, and frankly, in human history too, I guess, when the entire objective of what you're doing just suddenly pivots.
Oh, absolutely.
Yeah.
Like you spend that whole first half just trying not to starve.
Right. You're building a little shelter, you're gathering basic resources, and you're just hyper-focused on mere survival.
Yeah, you're just trying to weather the storm, really. Just keep your head down. But then, eventually, the perimeter gets secure, you have a surplus of food and storage, the storm finally passes.
And when that happens, the psychology of the player completely transforms.
It's a total shift, yeah.
You stop looking at the dirt in front of you, and you start looking at the horizon. You aren't just trying to survive anymore, you are trying to conquer.
Exactly. You move from defense to offense.
And today we are decoding the exact language of that kind of corporate conquest. We're looking at this fascinating transcript from a C2 advanced English learning series. And it acts as this, it's an absolute masterclass in the vocabulary of high finance and corporate empire building.
Yeah, and the mission for this deep dive is to really translate this highly visual, highly aggressive terminology for you. Because, understanding this isn't just about sounding articulate in a meeting.
No, it's way deeper than that.
Right. To truly understand the mindset of a Wall Street investor or like a Fortune 500 CEO, you have to realize that they borrow their daily vocabulary from agriculture, from casinos, and from aviation to describe financial dominance.
It's wild when you actually start listening for it. So let's get right into how these empires actually start. Before a massive company can take industry-shaking risks, they have to lay a foundation.
Right. They have to secure their territory.
Yeah. And the ultimate goal here isn't just to compete in an industry, is it? Because frankly, competing sounds a little too passive for these executives.
Oh, competing is often viewed as a failure at this level of business.
Really? A failure?
Yeah. The objective is to entirely capture the space,
right,
which is what insiders call cornering the market.
Cornering the market.
Right. And the origin of this phrase is a very physical, spatial metaphor,
Yeah.
The boxing ring.
Sure, like pushing a fighter into the corner.
Exactly. If a fighter manages to push their opponent into the corner of the ring, the opponent is trapped. They can't step backwards and they can't step sideways.
They're just completely immobilized.
Yeah, they're stuck.
Yeah.
And translating that boxing metaphor to economics, to corner a market, means to acquire such overwhelming control over a specific commodity or product or service that you effectively create a monopoly.
Right.
But the actual financial execution of this is what's truly fascinating. Because to trap an opponent economically, a company usually has to willingly lose billions of dollars for years.
See, I always find that part of the strategy so counterintuitive. You are trying to build an empire, but your first move is to bleed money on purpose.
It is a calculated bleed, though. To corner a market, you price your goods or services so artificially low that no smaller competitor can possibly match your prices and stay in business. Think about like a massive tech giant buying up every smaller streaming platform or subsidizing the cost of ride shares for a decade.
Oh, like when a ride across the city used to cost like $3.
Exactly. They operated at a massive loss just to choke the competition out of the ring. Eventually, consumers, meaning you, the listener, have absolutely no choice but to use their ecosystem.
Because everyone else went bankrupt.
Right. The market is cornered.
So you think you are choosing between 3 different services, but they're all owned by the same parent company. You are trapped in the corner.
Exactly.
But here is the mechanical question, right? How does a company survive bleeding billions of dollars for a decade to pull that off? You need an immense amount of capital to starve out everyone else in the ring.
Well, this brings us to the sustenance of the empire. To fund that aggressive boxing match, these companies rely on a completely different business model, operating quietly in the background, which is the cash cow.
Okay, let's unpack this because I think this is such a brilliant way to understand corporate structure. If we think about this like that strategy video game we were talking about, cornering the market is like locking down the map so nobody else can move.
Right.
But the cash cow,
yeah,
that is your passive income generator. It's the mechanism that just hums away in the background, printing money so you can safely go buy all the crazy experimental upgrades without going broke.
Yeah, that's exactly it. And what's fascinating here is the striking contrast in the metaphors themselves.
How so?
Well, on one hand, you have this incredibly aggressive, violent combat visualization of trapping a rival in a boxing ring, right?
Yeah, very physical.
And right next to it, funding the entire operation, you have this perfectly docile domestic image of a dairy farm.
It is a wild juxtaposition. You have a heavyweight fighter being sponsored by a dairy farmer.
It really is, but it perfectly captures the dual nature of empire building. In agriculture, once a dairy cow is fully grown, a farmer doesn't have to invest much time or new money into training it. The heavy lifting is pretty much done.
They just milk it.
Literally, they just walk out to the barn every morning and collect a reliable, steady supply of milk. So in business, a cash cow is a deeply profitable product or division where the research and development was, paid off years ago.
I used to wonder why tech companies keep releasing the exact same smartphone year after year with only microscopic changes. I mean, it always felt a bit lazy.
Yeah, a lot of people feel that way.
But looking at it through this lens, they aren't trying to innovate with that phone. That phone is the cow.
That is the perfect real-world application. A smartphone division might generate so much reliable, predictable revenue every single quarter that the parent company can afford to lose money aggressively cornering the market in unproven spaces.
Like virtual reality or autonomous driving.
Exactly. The domestic stability of the cow is mathematically necessary to fund the outward aggression of the boxer.
That makes so much sense. But that domestic stability doesn't just fund new projects, though, does it? It fundamentally changes the company's balance sheet.
Oh, absolutely.
Because the passive income from the cash cow eventually pays down the company's debt. And the moment that debt is cleared, the psychology of the C-suite seems to transform. They aren't just passively harvesting milk anymore. They start looking for a different kind of prey.
Right, because before they can actively hunt for spectacular wealth, they have to cross a very specific accounting threshold. They're finally in the black.
I love this one. This idiom has such a great, tangible origin story.
It really does, and it takes us back to how businesses functioned before digital spreadsheets. Accountants used to maintain physical ledgers, and when a company was operating at a loss or accumulating debt, the accountant recorded those negative figures using red ink.
Which explains why we still hear journalists say a failing company is bleeding red.
Exactly. The red ink visually signaled danger. It was a warning. But the moment a company finally generated surplus cash and became profitable, the accountant literally switched pens.
Ah, I see.
Yeah, the positive numbers are written in blank ink. So today, being in the black means a company is profitable and debt-free.
But getting into the black isn't just an accounting milestone. It's a massive psychological pivot for the leadership, isn't it?
Oh, for sure.
Because when a business is bleeding red, every single decision is rooted in fear and survival. You are answering to creditors.
Yeah, the anxiety of the red ink restricts your vision. You're just trying to stay afloat. But the moment a struggling business, and it doesn't matter whether it's a local restaurant or a multinational tech firm, the moment they get into the black, that fear just evaporates.
The chains are off.
Totally. The executives look at that surplus cash and realize they now have the ammunition to go on the offensive. They answer only to their own ambition.
And the language they use for this offensive push is incredibly intense. Being slightly profitable isn't the goal for an empire builder. They don't just want a nice, quiet surplus. They want to, quote, make a killing.
Yeah. We leap from accounting directly into the psychology of the hunt.
From the desk to the forest.
Right. Originally, making a killing was a literal description of a hunter successfully bringing down massive game. A successful kill ensured the village had a surplus of food to survive the harsh winter. It meant safety and wealth for the whole community.
It's the difference between foraging for berries every day to barely scrape by versus bringing down a mammoth that feeds everyone for months.
Exactly. And in modern finance, that hunting metaphor translates to generating a spectacular, highly lucrative profit almost overnight. It isn't about standard compounding interest over 30 years.
No, it's fast.
Very fast. Making a killing implies asymmetric risk, a perfectly timed business move that yields an explosive return.
Like someone buying a cheap, run-down property 10 years ago in a neighborhood that suddenly gentrifies, and they just cash out with millions of dollars. They didn't just earn a living, they made a killing.
Precisely. But to make a killing, you need flawless timing, which introduces another crucial concept from our sources. You have to strike while the iron is hot.
I have always loved this one. It's a blacksmithing metaphor.
It is, yeah.
But beyond just hitting hot metal, the core logic here is about windows of opportunity that are permanently close, right?
Yeah, exactly. When a blacksmith pulls a piece of iron from the forge, it glows red and is incredibly malleable. But it only stays soft for a fleeting moment.
Right. It cools down fast.
So fast.
Yeah.
And if the blacksmith hesitates to swing the hammer, The iron cools, it hardens, and the opportunity to change its shape is completely gone.
Wow.
In high finance, this means capitalizing on a perfect set of conditions instantly without waiting for, 5 committee approvals.
Yeah, I mean, the modern news cycle moves so fast now. If your biggest competitor suffers a massive PR scandal on social media, you don't have 3 weeks to plan a counter-campaign.
No, you definitely don't.
You have hours. You launch your marketing push that very afternoon to exploit their vulnerability. You strike while the iron is hot.
You exploit the weakness before the market can cool down and normalize the scandal.
Here's where it gets really interesting, though. I want to pause and look at the actual words we're using. We're talking about fundamentally positive financial milestones here. Getting out of debt, making a huge profit, timing the market brilliantly.
Right. All good things for the business.
Yeah, so why do we use such violent phrases like making a killing or striking an opponent when they are down? Does this imply that at the C-suite level, business is viewed as an inherently predatory act?
Well, if we connect this to the bigger picture, it stems entirely from the primal nature of resource gathering.
How so?
Ancient communities relied on the violence of the hunt for their very survival. Modern corporate language simply maps that primal, life-or-death urgency onto finance. A perfectly timed, aggressive business move. The kill ensures the dominance and survival of the corporation against its rivals. The language is predatory because, in their minds, outcompeting a rival is a modern survival mechanism. They are the apex predators of capitalism.
The apex predators? Wow. That primal urgency makes a lot of sense when you're fighting your way up the ladder. But let's follow the timeline of this corporate life cycle. You strike the iron, you make your killing, and you reach the absolute peak of corporate power.
Right, the very top.
You are now operating in the executive realm. And the language completely shifts again. We leave the forest and the forge, and we walk straight into a casino.
Yeah, the rules of risk change fundamentally when you reach the top of an empire. When a CEO sees a strategy working, they rarely play it safe and protect their winnings. They double down.
Which is a direct import from the blackjack table.
Literally, yes.
You look at your cards, you feel highly confident you have a winning hand, so right in the middle of the game, you double your original bet.
Exactly. And in a corporate setting, to double down means significantly escalating your investment or your effort into a strategy you believe is a winner. But notice the massive shift in consequence here.
What do you mean?
Well, at the blackjack table, if you double down and the dealer wins, you lose your own chips. But in the C-suite, a CEO doubling down might mean sinking an additional $50 million into an international advertising blitz just because an app performed well in one European market.
Ah, they are betting with house money. It's the shareholders' capital on the line, not their own.
Precisely. And this requires an incredible amount of hubris. They increase their exposure to maximize the win, trusting that their instincts are infallible.
But to make a $50 million bet on a hunch, that CEO needs absolute, unquestioned authority from the people backing them. They need what insiders call a blank check.
Yeah, a banking term that represents the absolute pinnacle of trust and unlimited resources.
Like a literal blank check.
Imagine taking your checkbook, signing your name at the bottom to legally authorize it, but leaving the monetary amount completely blank. You hand it to someone else and tell them, the budget is irrelevant. Fill in whatever number it takes to achieve the goal.
I cannot imagine ever handing someone a blank check in real life. The vulnerability is terrifying. If they write $1 billion, you owe $1 billion.
That is terrifying.
But in business, this seems to be the ultimate tool for rapid innovation.
It's the only way to win an arms race. If you want your engineers to design the most advanced electric vehicle battery in the world or the most powerful artificial intelligence model, putting financial constraints on them just slows them down.
Yeah, that makes sense.
A competitor who isn't worrying about budgets will beat you to the patent. So a blank check removes all friction. It is total financial backing to ensure victory.
So let's look at the incredible life cycle we've built here. An executive uses a cash cow to bleed the competition and corner the market. They get into the black, they strike while the iron is hot and make a killing. They earn a blank check, and they double down at the casino.
It's quite the journey.
But eventually, every game ends. The executive decides to retire, or maybe that $50 million blackjack bet goes completely wrong, and the board fires them. And when a top-tier executive exits the empire, they don't just get 2 weeks' pay and a handshake.
Oh, definitely not.
They get a golden parachute.
Now we are in the sky. It's an aviation metaphor for the executive exit strategy.
Right.
A parachute's only purpose is to save your life when a plane is going down. It allows you to eject from a catastrophic disaster and land softly and safely on the ground. But for these top executives, this parachute is woven out of solid gold.
We are talking tens of millions of dollars in guaranteed stock options, massive catch bonuses, and extended healthcare benefits, regardless of the circumstances of their departure.
Yeah, it is a contractual guarantee built into their hiring agreement. Even if they are forced out due to gross mismanagement or like a massive public relations nightmare, the parachute automatically deploys.
So what does this all mean? Because I have to push back on the logic of this one for anyone listening who works a normal job. This makes zero sense. A parachute is supposed to save you from a disaster. But in so many of these massive corporate scandals, the executive is the one who crashed the plane in the first place.
That's true.
The source material even points to CEOs stepping down amid public fury over a scandal, only to walk away with $50 million. Isn't a golden parachute literally just a multi-million-dollar reward for catastrophic failure?
This raises an important question, and analyzing this specific phrase exposes the ultimate disconnect at the very top of the corporate empire.
The disconnect.
Yeah. For a mid-level employee, performance dictates survival. If you crash the company car or you lose a major client, you are fired and you lose your livelihood.
Exactly.
But for the highest tier executives, their personal wealth is structurally divorced from their actual performance.
They are completely insulated from the consequences of their own actions.
Completely. The boards of these companies agree to these packages because they want their executives to take massive risky bets without the paralyzing fear of personal ruin.
So it's a safety net to encourage risk.
Exactly.
Yeah.
But the result is that the golden parachute guarantees they land safely in a pile of immense wealth, completely oblivious to the damage they left behind for the shareholders or the employees who are still, trapped in the burning plane.
Wow.
The language itself, a parachute made of gold, openly acknowledges that the normal laws of economic gravity simply do not apply to them.
It really is a separate reality up there. And that brings us to why decoding this language matters so much for you, the listener. If you want to understand the true mindset of a Fortune 500 CEO or a Wall Street insider, you can't just read their sanitized corporate mission statement.
No, those are PR documents.
Right. You have to listen to the metaphors they use when they're talking to each other.
The vocabulary they choose reveals their entire worldview.
They view the economy as a landscape to be ruthlessly conquered, hunted for game, and gambled upon with other people's money. Mastering these idioms, understanding cash cows, making a killing, doubling down, and golden parachutes does far more than just make you sound articulate in a boardroom.
Yeah, it gives you a decoder ring for how power actually operates.
Exactly. It allows you to hear the subtext of their strategy and recognize when you are the one being cornered in the market.
It's an incredible tool for navigating the business world.
It really is. And I want to leave you with a final provocative thought to mull over. We have spent this deep dive talking about how these idioms reflect the mindset of an industry insider. But think about the psychology of language for a second.
Okay.
If entire boardrooms of executives are constantly using violent casino-based metaphors to describe their daily jobs, does this language actually begin to shape their behavior?
Oh, wow. It is a chilling feedback loop to consider.
Right. Does talking constantly about making a killing and doubling down subconsciously encourage these leaders to take far more reckless, aggressive risks than they would if they were forced to use, neutral accounting terms?
That's a great point.
If you speak the language of a conqueror long enough, do you eventually force yourself to become one? Does the language of the empire actually create the emperor?
I mean, when your daily vocabulary revolves around the violence of the hunt and the hubris of the casino, it becomes very difficult not to act like a predator and a gambler.
It's definitely something to think about the next time you read a press release or hear a CEO give an interview. Well, thank you so much for joining us on this deep dive. It's been an absolute pleasure unpacking this with you.
Thank you so much for taking the time to listen.
Remember, we all start out just trying to build a shelter, but pay close attention to the words you use when you finally start looking at the horizon. Catch you next time.
Back in April of 2022, the board of directors at Twitter essentially threatened to set their own multi-billion-dollar platform on fire.
Yeah, just to stop Elon Musk from buying it.
Exactly. I mean, Musk had initiated what Wall Street calls a hostile takeover, right? He was basically bypassing the board entirely to try and snatch up a controlling stake.
Right. And in response, Twitter's board deployed this absolute doomsday protocol. It's written deep into their corporate bylaws.
And it's a financial mechanism that is literally referred to in SEC filings and boardrooms around the world as a poison pill, which is just such a wild term.
It really is. It's this incredibly aggressive, scorched earth defensive tactic. It's designed to just instantly dilute the company's own stock.
Making it, astronomically expensive for any invading force to gain control. So welcome to today's deep dive. We are unpacking a really fascinating set of source materials today.
We're looking at the language of mergers and acquisitions, or M&A.
Right. Our mission today is decoding these highly aggressive, totally militaristic metaphors that native English speakers use when they talk about global empire building in business.
Because the language of M&A reveals the actual psychological underpinnings of high finance, we have this comforting illusion that institutional investment is entirely rational,
Oh, for sure.
Yeah.
We picture this totally sterile precision, like perfect rows and columns on a spreadsheet.
Exactly. Balanced equations, fiduciary duties being executed by these executives in tailored suits, all just quietly nodding in some glass-walled boardroom.
But the actual lexicon, they use the literal words deployed by founders and activist investors. It paints a completely different picture.
It really does. That sterile spreadsheet is, linguistically speaking anyway, just covered in blood. I mean, it is a war zone.
It's a total war zone. And the sources highlight this distinct linguistic shift, which I found so interesting. It correlates perfectly with a company's maturity.
Right. Like when a company is in its growth phase or just maintaining steady profitability, the terminology is remarkably peaceful.
Yeah, you hear standard, boring accounting idioms.
Oh, yeah.
Management talks about striking while the iron is hot when they launch a product.
Or they talk about ensuring the quarterly reports keep the firm securely in the black.
Right. Very domestic, very safe.
Because the terminology of that peaceful growth phase is entirely internal. It's focused on operational efficiency and basic margin protection.
But once a corporation actually achieves peak financial success, once an empire is built and market dominance is established, attention is drawn.
Always. Success in a capitalist framework is basically a beacon for competition. In any major industry, a firm eventually hits this critical mass where organic growth just plateaus.
And at that inflection point, the whole strategic imperative shifts. You either need to acquire your competitors to maintain your growth, or
a larger conglomerate is going to try to acquire you. It's eat or be eaten.
Exactly. And the second that inflection point is reached, all that peaceful accounting terminology just completely evaporates.
The language instantly transitions into this ruthless lexicon of survival, strategy, and outright combat.
We are looking at billion-dollar capital allocations being described with idioms pulled straight from, like, the boxing ring or the butcher shop.
Cold War espionage, too, and the apex predators of the animal kingdom.
Yeah. And for you listening, mastering these specific idioms isn't just some exercise in expanding your vocabulary. It is the ultimate toolkit for decoding financial reality.
Understanding the mechanics behind these phrases lets you instantly parse through all those sanitized corporate press releases.
Right. You get to understand the true motives of activist hedge funds.
Right.
And it genuinely helps you engage in high-level business fluency.
So to understand the warfare, we really first have to map out the competitive landscape.
Yeah.
Because the board is set long before the proxy fights actually begin.
Right. Before anyone launches an attack.
Exactly. In almost any mature sector, market share is rarely distributed evenly. You typically have an oligopoly or just one massive incumbent that dictates the rules.
And the sources point to a very specific ancient idiom used to describe this dominance. The incumbent doesn't just hold a majority market share.
No, they hold the lion's share.
The lion's share. I find the origin of this one so fascinating because we are basically applying a concept from a pastoral Aesop fable to modern tech monopolies.
It's a great contrast, isn't it?
It is. The fable basically dictates that a lion goes hunting with a coalition of smaller animals. They collaborate and they bring down this stag.
But then comes the time to divide the calories, basically, the yield of the hunt.
Right. And the underlying power dynamic asserts itself immediately. The lion doesn't care about equitable distribution or, fair labor practices.
Not at all. It leverages its inherent terrifying capacity for violence.
Exactly. The simple, undeniable fact that it could just easily slaughter the rest of the hunting party. So it uses that threat to claim almost the entire carcass.
It leaves absolutely nothing but the most pathetic scraps for the smaller animals who actually did the work to facilitate the hunt.
It is the purest distillation of monopoly power.
And applied to modern economics, the lion's share is often misconstrued by everyday people as simply meaning a large piece.
Right, like, oh, I ate the lion's share of the pizza.
Exactly. But in high finance, it denotes the absolute, overwhelming, and often coercive majority of a resource.
Coercive being the key word there.
Yes. It implies a level of market concentration that borders on monopolistic intimidation.
So the incumbent wields this immense structural power, whether it's through network effects, economies of scale, or just massive patent moats.
And smaller entities have literally no choice but to accept the scraps of margin left over.
We see the mechanics of this so perfectly in the digital advertising duopoly right now.
Oh, absolutely.
Like, there are dozens of search engines globally. Bing, DuckDuckGo, various localized portals. But Google takes the lion's share of global search advertising revenue.
They capture something north of 90% of the market share in search.
Right, and because their programmatic ad exchanges are so deeply entrenched in the actual architecture of the internet, smaller publishers just have to play by alphabet's rules.
They just have to accept the terms of service. They accept whatever revenue splits Google decides on because the lion has the power to unilaterally cut off their traffic overnight.
It's wild. Or, look at Apple in the smartphone sector.
That's another perfect example. Android might have a larger, raw global market share in terms of actual devices in people's hands.
But Apple historically captures the lion's share of the actual profits in the global smartphone market.
Through ecosystem lock-in and just incredible premium pricing power, they often extract 70 to 80% of the entire industry's operating profit.
Leaving like a dozen other multinational hardware manufacturers to just viciously fight over the remaining 20% just to break even.
The lion commands the profit pool, but the thing is, smaller entities don't always just resign themselves to fighting over those scraps.
Right, the scrappy startups, the mid-cap disruptors.
Occasionally, a highly aggressive, deeply innovative firm looks at the incumbent's massive size and decides to launch a direct asymmetric assault.
And the financial media uses this brilliant boxing metaphor for this exact dynamic. When a small company successfully challenges a titan, they are said to be punching above their weight.
The mechanics of combat sports translate remarkably well to corporate strategy, honestly.
They really do. Boxing is structurally regulated by weight classes, right? Lightweight, middleweight, heavyweight.
Because physics dictates the outcome of a physical fight, force equals mass times acceleration.
Right, so a 250-pound heavyweight will inherently generate so much more kinetic energy than a 130-pound lightweight.
A crossweight bout isn't even a competition at that point. It's a structural inevitability. The regulations literally exist to prevent a massacre.
Yet, every so often, a lightweight fighter emerges who is just so unnaturally fast, so technically precise, and ruthlessly disciplined.
They completely neutralize the heavyweight's mass advantage.
Exactly. If they actually stepped into the ring, they could systematically dismantle the larger opponent. And idiomatically, in the corporate arena, this describes a small entity successfully eroding the market share of a massive incumbent.
A classic historical example of this is the early days of Netflix versus Blockbuster.
Oh, that is the ultimate example.
Blockbuster was the undisputed heavyweight. They had thousands of brick-and-mortar locations, massive cash flow, and deeply entrenched studio relationships.
And Netflix was this lightweight startup, just mailing DVDs in red envelopes.
But Netflix had structural agility. They didn't have the incredible overhead of physical real estate, and they were leveraging early data analytics to predict consumer behavior.
So they were punching above their weight by using speed and precision to offset Blockbuster's massive scale.
And eventually, they bled the giant out entirely. Blockbuster went bankrupt.
We see it constantly in the tech sector today, too, with independent software studios.
Oh, yeah, all the time. A 50-person development team utilizing agile methodologies, lean code bases, and cloud infrastructure.
They can build a platform that directly threatens a monolithic product from, say, Microsoft or Salesforce.
Because the giant has 10,000 engineers, sure, but they are bogged down by legacy code, bureaucratic compliance, and internal politics.
The 50-person studio iterates 10 times faster. But, it creates this really fascinating juxtaposition in the language we use.
How so?
Well, we are deploying these pastoral ancient fables about apex predators in the wilderness, alongside brutal, modern blood sport metaphors about men physically destroying each other in a ring.
Right, and all to describe the actions of software developers in Silicon Valley typing lines of code on laptops.
Exactly. It strips away the whole veneer of modernity.
It proves that despite the digital abstraction of our current economy, the underlying human drive for dominance is just as primal as it was 10,000 years ago.
Whether we are fighting over a freshly killed stag on the savannah or competing for monthly recurring revenue on a SaaS platform, the psychological framework is identical.
We conceptualize market dynamics as predator, prey, and physical combat.
And I guess that primal framework explains why this dynamic inherently and inevitably leads to conflict.
It does. The incumbent, the lion, demands the lion's share. When that lightweight, agile startup transitions from being a cute, localized disruptor to a genuine existential threat,
The paradigm shifts completely. The startup is now actively eating the lion's meat.
and incumbents absolutely despise margin compression. When a massive corporation identifies a legitimate threat, the standard playbook is not to engage in a protracted price war.
Right, because a price war just destroys value for both parties. The strategic move is simply to absorb the threat.
They deploy their massive cash reserves to initiate an acquisition. The giant approaches the startup with a term sheet, offering a massive premium on their current valuation.
It always starts as a polite, friendly negotiation. We admire your technology. We want to integrate your team into our ecosystem. Here is a life-changing amount of liquidity.
A standard, friendly merger. The board agrees, the founders vest their shares, and the ecosystem consolidates. Everyone is happy.
But the friction arises when the founders of that smaller, successful entity refuse to capitulate. They just reject the term sheet.
Because maybe they believe their long-term independent valuation far exceeds the immediate premium being offered.
Or they simply refuse to surrender their autonomy to some bureaucratic conglomerate. They just say no.
And the refusal of a friendly acquisition is the spark that ignites the powder keg.
Because a conglomerate with billions in dry powder doesn't just pack up its briefcase and respect the startup's boundaries.
No, the rejection triggers an escalation into outright war. The giant initiates the second phase of our linguistic journey today, the attack.
They launch a hostile takeover. And this is where we fully enter the realm of militarized corporate finance.
The terminology itself, takeover, hostile, target, it is entirely appropriated from military strategy.
Right, because a standard acquisition relies on mutual consent. It only becomes categorized as hostile when the target company's board of directors explicitly rejects the proposal.
And actively attempts to block the transaction.
The mechanics of bypassing a hostile board are just incredible to me. The invading company doesn't even bother trying to persuade the CEO or the directors anymore.
Because they recognize that the board is essentially the fortified wall of the corporation.
Yes. So instead of battering down the wall, the aggressive buyer exploits the fundamental structure of publicly traded equities.
They go directly to the individual public shareholders, the institutional investors, the pension funds, and the retail traders who actually hold the equity.
They launch what is known as a tender offer. The hostile buyer publicly bypasses management and offers to purchase shares directly from the stockholders.
And they do it at a substantial premium above the current market price.
Right. So if the target company's stock is trading at $50 on the open market, the hostile acquirer might file a public tender offer at, say, $80 a share.
But it's contingent on acquiring enough shares to secure a controlling interest.
And that creates an immediate, visceral prisoner's dilemma for the shareholders.
It really does, because if I'm an institutional portfolio manager holding 1 million shares, I am suddenly looking at an instant, risk-free $30 million profit.
But if you refuse to sell and the takeover fails, the stock will likely plummet back down to $50.
Exactly. So the financial incentive to betray the board of directors and take the invading army's cash is just overwhelming.
The hostile acquirer, quietly or sometimes very loudly, accumulates these tendered shares until they cross the magic threshold.
51% ownership, or, in some corporate structures, whatever percentage constitutes a controlling voting bloc.
And once that threshold is breached, the war is functionally over.
The hostile acquirer now possesses the voting power to unilaterally dismiss the existing board of directors, terminate the CEO, and forcibly integrate the target company's assets.
The history of M&A is just littered with these brutal maneuvers.
It is. A great example to look at is the infamous 2008 Porsche and Volkswagen saga.
Oh, that is one of the most brilliant, stealthy, hostile maneuvers ever executed.
Because VW was the massive incumbent heavyweight, right? Porsche was much smaller, seemingly incapable of buying the giant.
But Porsche didn't announce a tender offer. That was the genius part.
Right. They quietly used complex financial derivatives, cash-settled options, to secretly lock up the rights to nearly 74% of Volkswagen's voting stock over months.
It was an absolute masterclass in asymmetric financial warfare.
And when Porsche finally revealed their hand and announced their position to the market, it triggered the most violent short squeeze in history.
Because hedge funds that had bet against VW stock were suddenly trapped. They were desperately trying to buy shares to cover their shorts, but the shares simply weren't available anymore.
Porsche completely cornered the market.
For a brief moment, Volkswagen actually became the most valuable company on the planet by market capitalization, purely driven by the mechanics of a stealth, hostile takeover.
It's a crazy story, and it perfectly illustrates that medieval castle siege analogy you were talking about earlier.
Yes, I love this analogy. You have a fortified castle, the walls are impenetrable, that's the board of directors. The invading army demands surrender.
And the king on the wall says, "No, we are secure."
So the invading army ignores the king. They send emissaries through the moat into the village square and start handing out heavy bags of gold directly to the citizens.
They tell the citizens, "If we give you enough gold, will you just walk over and open the front gates from the inside?"
And driven by raw economic self-interest, the citizens gladly sell out the king and open the gates.
The analogy perfectly exposes the inherent structural vulnerability at the heart of public markets.
Because when a founder decides to take their company public via an IPO, they are making a Faustian bargain.
They gain access to immense capital liquidity, which allows them to scale their operations globally.
But in exchange, they fundamentally diffuse their ownership. They sell off pieces of their sovereignty.
And the hostile takeover exploits the reality that the citizens, the shareholders, often have absolutely no ideological loyalty to the castle's independence.
Their mandate is usually just immediate, maximized financial return.
Which makes sense for them, but if you're a visionary founder, that reality is terrifying.
You can spend decades building an innovative empire, only to find yourself ousted from your own creation just because a consortium of activist hedge funds decided they wanted a quick payout.
They opened the gates to a rival conglomerate. But, the architecture of corporate law has evolved specifically to address this vulnerability.
A target company is not defenseless when the hostile tender offer is launched.
Not at all. Just as there are aggressive acquisition strategies, there is a very deep arsenal of defensive tactics.
When the invading force tries to bribe the citizens, the board can activate highly complex, legally sanctioned countermeasures.
Which brings us back to the most dramatic, scorched earth defensive strategy in the entire corporate playbook.
The one we mentioned at the top of the show with Elon Musk and Twitter. It is known universally on Wall Street as the poison pill.
The terminology here is incredibly evocative. Poison pill. It immediately conjures the grim imagery of Cold War espionage.
It really does. You picture a captured intelligence operative in an interrogation room.
The enemy is preparing to extract state secrets, perhaps through torture.
And right before the operative breaks, they bite down on a false molar, crack a cyanide capsule, and die within seconds.
They intentionally destroy themselves to ensure the enemy gains absolutely nothing of value.
It is the ultimate act of defiant self-sabotage.
And that exact philosophy of defiant self-sabotage drives the financial mechanics of the corporate poison pill.
Formerly known in legal terms as a shareholder rights plan.
Right. It is a structural mechanism designed to immediately halt a hostile takeover by making the target company's stock toxically expensive.
And practically impossible to consolidate. The mechanics of a shareholder rights plan are just brilliant.
To understand how you poison a company, you have to look at the corporate charter. A board of directors will proactively adopt a poison pill provision, often keeping it dormant for years.
It acts like a tripwire.
Exactly. The provision dictates that if any single shareholder, the hostile acquirer, purchases stock that pushes their total ownership above a specific threshold, say 15%, the tripwire is triggered.
And when that tripwire snaps, the flip-in provision activates.
This is where it gets crazy. The target company's board authorizes the immediate issuance of millions of brand new shares of stock.
But they don't just sell these on the open market, right?
No, they offer these new shares at a massive discount, sometimes 50 cents on the dollar, exclusively to every single existing shareholder of record.
With one glaring exception.
The hostile acquirer.
Right. The invading army is legally excluded from buying the discounted shares.
So let's look at the mathematical impact of that. If a hostile raider has spent billions quietly accumulating 15% of a company, and the poison pill triggers,
The company suddenly floods the market with cheap stock that everyone else scoops up.
and the raider's 15% ownership is instantly diluted down to maybe 3 or 4%, their voting power just evaporates overnight.
It is a devastating counterattack. It achieves two catastrophic things simultaneously for the hostile buyer.
First, it means that to actually acquire a 51% controlling stake, the raider now has to purchase millions of additional shares they hadn't budgeted for.
Making the acquisition astronomically expensive. And second, by flooding the market with new equity, the target company actively dilutes its own earnings per share.
They are intentionally driving down the fundamental value of their own stock.
We saw the legality of this firmly established during the chaotic corporate raiding era of the 1980s.
Specifically, in the landmark 1985 Delaware Supreme Court case, Moran v. Household International.
The court ruled that boards do indeed have the fiduciary right to adopt these poison pills without direct shareholder approval.
Validating it as a legal defense mechanism against coercive tender offers.
But it completely flips the concept of fiduciary duty on its head. To return to the analogies, this is the equivalent of realizing a heavily armed burglar is trying to break into your mansion.
So you systematically pour gasoline over your own living room furniture and strike a match.
Yes. You set your own house on fire, hoping the burglar looks through the window, sees the flames, and decides the property is no longer worth robbing.
It is the financial equivalent of mutually assured destruction.
But how does a CEO or a board of directors rationally justify this to their shareholders?
It's tough.
The entire legal mandate of a public company board is to maximize shareholder value. How can they legally justify intentionally diluting and destroying the financial value of the stock just to thwart a buyer who is offering a massive premium?
It highlights a profound friction between short-term profits and long-term strategic vision.
Okay.
In corporate warfare, a board utilizing a poison pill will argue that maintaining their independence will ultimately generate vastly more shareholder value over a 10-year horizon than capitulating to a short-term premium today.
They argue that the hostile bidder is actually attempting to steal the company's future value on the cheap.
Exactly. The extreme survival instinct overrides the immediate payout.
They prioritize sovereignty over short-term liquidity.
Furthermore, the strategic brilliance of the poison pill is that it is fundamentally a deterrent. A board rarely ever actually has to issue the discounted shares.
Just the knowledge that the cyanide capsule is strapped to the company's balance sheet is usually enough.
Right. It stops a hostile raider from crossing that 15% threshold. It neutralizes the aggressive attack and forces the hostile bidder to abandon the tender offer.
And come to the negotiating table to try and structure a friendly merger.
So a company navigates the warfare. Perhaps they succumb to a massive merger, or perhaps they barely survive a grueling hostile siege by threatening to swallow the poison pill.
But regardless of the outcome, a massive conflict has just occurred. The battle is over, the dust is settling in the boardroom, and the financial reality is usually bleak.
The post-conflict landscape is almost always characterized by financial exhaustion.
Legal teams charging thousands of dollars an hour have been paid. Massive debt may have been accumulated to fend off the raider. Operations have been distracted for months.
And now, the surviving executive team has to sit down, open the depleted ledger, and begin wielding a knife.
We are now entering the aftermath phase. Budgetary surgery and efficiency.
The sources highlight a specific, visceral idiom universally used to describe the management of post-conflict corporate budgets.
Executives will announce to the shareholders and the press that it is time to trim the fat.
We have left the battlefield and walked straight into the slaughterhouse. The butcher metaphor is incredibly prevalent in restructuring.
Think about the physical act of preparing meat. When a butcher acquires a massive primal cut of beef, it is surrounded by thick layers of dense, inedible adipose tissue.
This fat is heavy. It costs money per pound, but it provides virtually no culinary or nutritional value to the final product.
It's basically dead weight.
Exactly. So to maximize the value of the cut, to make the meat lean, appetizing, and highly profitable for sale, the butcher takes an exceptionally sharp knife.
And aggressively slices all that useless tissue away, discarding it and leaving only the prime valuable muscle.
Translating that visceral physical act to corporate finance, when a newly installed CEO or a private equity firm announces they are trimming the fat, they are initiating aggressive operational cuts.
This often follows a leveraged buyout. or LBO, right?
Yes, very common after an LBO.
Yeah.
In a leveraged buyout, a raider uses the target company's own assets as collateral to borrow the massive amounts of money needed to buy them.
So the newly acquired company is suddenly saddled with hundreds of millions in high-yield debt.
They literally cannot afford their previous operating expenses because all their cash flow is now diverted to servicing the interest on that debt.
The mandate becomes extreme efficiency. Trimming the fat means bringing in specialized accounting teams to identify and eradicate structural redundancies.
If two companies merged, you don't need two human resources departments. You don't need two marketing teams.
The executives identify overlapping divisions, close regional offices, liquidate underperforming subsidiaries, and severely reduce the global headcount.
They discard the operational weight that isn't directly generating revenue.
And this is where we really have to examine the profound psychological utility of the language itself. Because this metaphor is incredibly clinical, almost chillingly so.
It is.
When an executive team decides to close 3 regional manufacturing plants, they aren't just erasing a line item on a spreadsheet.
No, they're terminating the employment of thousands of human beings, people who have mortgages, medical bills, and children.
But the language, trimming the fat, it linguistically transforms those human beings into inedible, useless waste on a carcass.
It functions as a necessary psychological shield for the executives wielding the knife. Language shapes cognitive framing.
If a CEO sits in their office and consciously meditates on the fact that their signature on a restructuring document is about to financially devastate 3,000 families, the emotional toll would be paralyzing.
The burden of that reality makes executing rational financial strategy nearly impossible.
By utilizing these euphemisms, by framing dedicated employees and legacy projects as redundancies, synergies, or fat, the executive team distances themselves from the human cost of the transaction.
It sanitizes the brutality. It makes a ruthless, life-altering decision feel like routine clinical maintenance.
Like, we aren't hurting anyone. We are simply making the organism healthier. We are ensuring the survival of the core muscle.
It deliberately obscures the reality of what is being done. But from a purely structural standpoint, trimming the fat implies a fundamental optimism.
How so?
Well, it implies that the core muscle, the underlying business model, is still healthy and viable once the excess is removed. The product still has a market fit.
But that optimism isn't always warranted. What happens when the underlying business model is fundamentally broken?
You can aggressively trim the edges of a steak, but if the entire cut of meat is rotten to the core, no amount of knife work will save it.
Sometimes an entire division, a highly anticipated new product line, or even the core technology itself is completely unviable.
And navigating that reality requires a completely different level of corporate action. You can no longer trim, you must terminate.
Which brings us to the final phase of corporate warfare, the surrender, escaping the psychological traps of total failure.
Our sources provide 2 deeply interconnected idioms for dealing with absolute defeat, and the first is one of the most sudden and fatal metaphors in the business lexicon.
Pull a plug?
The origins of pulling the plug are rooted in heavy electrical machinery, or more evocatively, medical life support systems.
If a patient is on a ventilator or a massive industrial machine is running, it requires a continuous, uninterrupted flow of electrical current to function.
And the absolute millisecond you reach over and sever that connection, when you pull the plug out of the wall, the power drops to 0.
There is no gentle winding down. It is an immediate, fatal cessation of activity.
In business, this describes the abrupt, complete termination of a failing initiative.
A company might spend 3 years and $50 million developing a revolutionary new consumer hardware device.
They launch it with a massive marketing campaign, but the market totally rejects it.
Reviews are terrible, supply chain issues arise, and units are just sitting in warehouses gathering dust.
Instead of keeping a massive team of engineers and marketers on payroll to try and pivot the product, the executive board simply walks in and pulls the plug.
The servers are shut down, the supply chain contracts are voided, the remaining inventory is written off as a total loss, and the staff is either aggressively reassigned or terminated.
It is absolute. And the reason executives must possess the discipline to pull the plug, the reason it is considered a vital survival skill in high-stakes management,
is to avoid falling victim to one of the most destructive psychological forces in economics.
the force described by our final idiom, throwing good money after bad.
To understand the mechanics of this phrase, we have to examine its origins in the world of high-stakes gambling. It perfectly encapsulates irrational human behavior under financial distress.
Imagine walking into a casino with a stack of your hard-earned savings. You sit down at a blackjack table, misread the odds, make a terrible strategic decision, and instantly lose $10,000.
That $10,000 is gone. The house has it. It is now the bad money.
Rationally, the mathematical move is to accept the negative variance, stand up, and walk away from the table.
But human beings are rarely governed by rationality when they experience a sudden loss. The ego is bruised. The psychological pain of admitting a $10,000 mistake is intense.
So instead of accepting reality, you reach back into your wallet, you pull out another $10,000 of your savings.
This is the good money. It's safe.
But driven by emotion and the desperate desire to erase the mistake, you bet the good money on the exact same flawed strategy, desperately hoping to win the original losses back.
You throw the good money after the bad. And inevitably, the house takes that too.
In behavioral economics and corporate finance, this exact phenomenon is formally categorized as the sunk cost fallacy.
It is a cognitive bias that has bankrupted monolithic corporations.
The sunk cost fallacy occurs when an executive team foolishly continues to allocate capital, manpower, and resources into a demonstrably failing project simply because they have already invested so much into it.
They cannot psychologically separate themselves from the capital that has already been destroyed, the sunk cost.
We see this constantly in capital allocation. Let's look at the Blockbuster example again.
Long after it was mathematically obvious that physical retail DVD rentals were a dying business model, Blockbuster launched Total Access,
which was this hybrid program trying to compete with Netflix's mail service while maintaining their massive retail footprint.
They poured hundreds of millions of dollars into a logistical nightmare. They were throwing good money after bad.
Desperately trying to validate the billions they had already spent building thousands of physical stores, instead of aggressively pulling the plug on retail and pivoting purely to digital delivery.
Or consider a less glamorous, everyday operational example. Say a logistics company has a fleet of aging delivery trucks. The transmission fails on a truck.
The manager authorizes a $5,000 repair. A month later, the engine block cracks.
Logic dictates the asset is fully depreciated and should be sold for scrap to buy a reliable new vehicle. But the sunk cost fallacy takes hold.
The manager thinks, I already authorized $5,000 in repairs last month. If I scrap the truck now, that $5,000 was totally wasted.
I have to authorize another $10,000 to fix the engine to justify the first repair.
They are throwing perfectly good capital into a depreciating asset just to protect their ego. The concept of opportunity cost is completely ignored.
The money being wasted on the broken truck could have been used to generate new revenue with a new vehicle.
And this concept extends far beyond the boardroom. It's the one aspect of corporate warfare that mirrors our daily lives flawlessly.
The psychology is so universal. You don't need to be navigating a billion-dollar merger to fall victim to the sunk cost fallacy. We do this in our personal lives constantly.
Oh, absolutely. People will remain in deeply toxic, unfulfilling relationships for years, not because they are genuinely happy, but because they rationalize the sunk cost.
They think, I've already invested 5 years of my life into this person. If I pull the plug and walk away now, those 5 years were a total waste.
Or dedicating years to a university degree you realize you hate in your sophomore year, but finishing it anyway because you already paid for the first 4 semesters.
Exactly. It is the identical psychological mechanism. We despise admitting defeat.
We hate acknowledging that our initial strategy was flawed, whether we are managing a hedge fund portfolio or managing our own lives.
We throw good years after bad years.
And that reality synthesizes the core truth of corporate warfare. We spend so much time analyzing and glorifying the aggressive kinetic maneuvers.
We marvel at the sheer dominance of the incumbent demanding the lion's share. We root for the agile startup punching above its weight.
We study the ruthless proxy fights and tender offers of a hostile takeover, and the dramatic scorched earth defiance of a board swallowing a poison pill.
But the ultimate sign of a genuinely elite executive, and frankly, a wise individual in any context, is the discipline to recognize when a battle cannot be won.
Sometimes the most strategic, mathematically sound move in corporate warfare isn't launching a counteroffensive or trimming the fat.
It is accepting the loss. It is acknowledging the sunk cost, protecting your remaining good capital, pulling the plug, and simply walking away from the table.
By surrendering the immediate battle, you preserve the resources necessary to build an empire somewhere else.
This has been an incredible journey through the hidden linguistics of high finance. We've decoded the ancient fables applied to digital monopolies, the boxing metaphors of asymmetric competition,
The medieval siege tactics of activist hedge funds, and the clinical butcher shop euphemisms used to sanitize massive layoffs.
Engaging deeply with these idioms and understanding the complex financial mechanics they represent is the fastest way to integrate them into your active vocabulary.
You are now equipped to read between the lines of a sanitized press release, understand the structural motives behind a proxy fight, and actually see as the ruthless strategy playing out in real time.
It demystifies the entire global economy. Once you recognize the terminology, the seemingly chaotic or irrational actions of multi-billion-dollar conglomerates start to make perfect, calculated sense.
We always expect the world of finance to be a realm of pure, emotionless mathematics. But our language proves that it is entirely fueled by primal human aggression, ego, and the desperate drive for survival.
Which leaves me with a final, lingering thought for you to mull over as we conclude today's deep dive.
A philosophical framing of the mechanics we've discussed.
Precisely. If we accept that language fundamentally shapes our cognitive reality, if the words we utilize dictate how we perceive and execute our actions,
Does constantly deploying the vocabulary of warfare, apex predators, poison, and slaughterhouses in business actually create a more hostile, ruthless corporate environment?
does the language itself make executives colder and more aggressive? Or is the language simply an honest, unflinching reflection of base human nature when billions of dollars in absolute power are on the line?
Do we control the language of empire building, or does the language control us?
Keep an ear out for those words the next time you read the financial news. Until next time, thanks for joining us on The Deep Dive.